Imagine opening your trading app and realizing that you don't need thousands of dollars to own shares in real American companies, not startups with no revenue, not hype-based penny stocks, but real businesses with millions of customers, global operations, and years of history, all trading under $25 per share. Most people think investing in the US stock market is only for those who can afford expensive names like Apple or Microsoft. But the truth is, some of the most interesting opportunities often sit quietly under $25, ignored, misunderstood, and underestimated. Today, we're talking about those companies. Companies like Sophie Technologies, AT&T, Pinterest, Nokia, and JetBlue Airways. These are not lottery tickets. These are real businesses, and by the end of this video, you'll understand why their stock prices are low, what potential they carry, and what risks you must respect before investing. Let's be clear from the start. A stock price does not tell you how big or how strong a company is. A $20 stock is not cheaper than a $200 stock in terms of value. What matters is market capitalization, revenue, growth, debt, and future expectations. Many strong companies trade under $25 because the market is uncertain about their future, not because their business has disappeared. And that uncertainty is exactly where opportunity and risk live together. First, let's talk about Sophie Technologies. Sophie is not just another finance app. It started as a student loan refinancing company, but today it's building a full digital financial ecosystem. Banking, personal loans, credit cards, investing, insurance, everything inside one platform. Millions of users, especially younger generations, are choosing Sophie as their primary financial app. So why is the stock under $25? Because Sophie is still in its growth phase. It reinvests heavily into expansion, technology, and customer acquisition. The market often punishes companies that focus on growth before profits. But long-term investors understand that building infrastructure takes time. Sophie's stock price reflects patience being tested, not a broken business. Now, let's move to AT&T. This is a company almost everyone knows. Wireless networks, broadband internet, millions of customers across the United States. AT&T generates massive revenue every year, so why is its stock trading under $25? The answer is debt and slow growth. AT&T expanded aggressively in the past, made costly acquisitions, and now focuses on stabilizing cash flow and paying dividends. This stock isn't about excitement or hype, it's about stability. Investors who look at AT&T are often looking for consistency, income, and long-term holding. The market keeps the price low because growth is slow, but slow does not mean dead. Next, let's talk about Pinterest. Many people underestimate Pinterest because they think it's just another social media app. But Pinterest is different. People go there with intention, to plan, to buy, to discover ideas. That makes Pinterest extremely valuable to advertisers. Brands love platforms where users are already in a buying mindset. Pinterest has hundreds of millions of monthly active users worldwide. So why is the stock under $25? Advertising markets move in cycles. When companies reduce ad spending, Pinterest feels the pressure. But when advertising rebounds, Pinterest benefits strongly. This is why investors see Pinterest as a recovery and growth play rather than a collapsing business. Now let's talk about Nokia. Many people remember Nokia as a phone company from the past. But today, Nokia is not about smartphones. It's about telecom infrastructure, 5G networks, enterprise connectivity, government and defense contracts. Nokia builds the backbone of communication systems around the world. So why is Nokia's stock under $25 and often much lower? Because infrastructure companies grow slowly. They don't create viral excitement. Their revenue is stable but not explosive. The market prefers fast growth stories, and Nokia is a long-term infrastructure story. Patient investors understand that these types of companies benefit quietly as global connectivity expands. Now, let's look at JetBlue Airways. Airlines are always emotional stocks. When the economy is strong and travel demand is high, airline stocks rise. When fuel prices increase or economic uncertainty appears, airline stocks fall fast. JetBlue is a well-known all-US airline with a loyal customer base and strong brand recognition. So why is the stock under $25? Because airlines operate on thin margins. Fuel costs, labor costs, and economic cycles heavily impact profitability. JetBlue's stock price reflects caution, not irrelevance. Investors who look at airline stocks must understand cycles and timing. Here's something important you must understand. Under $25 stocks are often at turning points. They are either rebuilding, stabilizing, or waiting for the next economic cycle. SOFI represents growth and innovation. A TNT represents stability and income. Pinterest sits between growth and advertising cycles. Nokia represents infrastructure and long-term contracts. JetBlue represents economic recovery and travel demand. These stocks are not the same, and they should not be treated the same. These types of stocks are especially attractive for new investors. If you're starting with limited capital, under $25 stocks allow you to build positions without emotional pressure. They're also suitable for dollar-cost averaging, investing small amounts consistently over time instead of trying to time the market, but they are not magic. They require research, patience, and discipline. Let me say this clearly. Low price does not mean low risk. Some under $25 stocks stay under $25 for years. Some recover strongly. Some never do. That's why understanding the business matters more than watching the chart. You must ask questions. Is the company generating revenue? Is debt manageable? Is management improving the business? Is the industry growing or shrinking? Too many people chase hype stocks and panic during market downturns. Smart investors think differently. They look for real businesses when the market is uncertain. They understand that wealth is built slowly, not overnight. Most successful investors didn't win because they were lucky. They won because they were patient when others were emotional. If you take one thing from this video, let it be this. You don't need expensive stocks to build wealth. You need understanding, patience, and consistency. Companies like SOFI, AT&T, Pinterest, Nokia, and JetBlue Airways are real US companies trading under $25 today. Whether they succeed tomorrow depends on execution, market conditions, and time, not hype. Do your own research, think long-term. Invest money you can afford to hold. And remember, the market rewards patience far more than excitement. If you found value in this video, make sure to like it, subscribe to the channel, and comment below which under $25 US stock you believe has the strongest future. This channel is about learning, not gambling, and the journey has just begun.